The Mag 7, NVIDIA, Apple, Microsoft, Amazon, Alphabet, which is Google, Meta, and Tesla. These 7 companies have returned an outsized 870% in the past 10 years, from 2016 to 2025. Okay, compare that to the S&P 500's 248%, and you can see why investing in those 7 companies alone will have produced outsized market-beating returns in your portfolio. The downside, however, is when these companies fall, they fall pretty hard. In 2022, we saw a prolonged drop in the market. Those 7 companies dropped about 41.3%. Compare that to the S&P 500's 19.4% fall. So based on that year, when the market falls X, the Mag 7 falls 2X. So these 7 companies make up about a third of the S&P 500. Remember, that's 500 different companies. And the thing is that these companies are high volatility, high growth. If you spread your money out and you diversify, you're more stable, but you're not getting those returns. But the thing is we don't know what the returns are going to be in the future. We don't know if the Mag 7 can keep on producing like they have historically. So the risk of just investing your money into 7 companies is very high risk, as opposed to spreading your money out across 500 different companies. There's still risk there, but it's a little bit more moderated because you're getting that broad sector exposure. So the Mag 7 have driven the vast majority of the growth in the S&P 500. So in just 2023 alone, those 7 companies rose about 76%. Compare that to 24% in 2023. So you're getting a 3x performance percentage-wise in 1 year if you invested in those 7 companies. Now, the thing is there is some concentration risk. So the top 10 stocks in the S&P 500 account for nearly 39% of the total index value. And that is a level that is exceeding that of the 1999-2000 tech bubble. So there is talk, are we seeing an AI bubble? All these companies are pretty exposed to AI. If there's weakness in the market, are we going to see these stocks completely crash? What's going to happen? What we're going to analyze in this video is those 7 companies, and each of those companies will be compared to something that is in the same sector or the same industry. So we're going to do a little comparison and see maybe the Mag 7 is still where we want to be, or maybe we want to start parking our money into something similar but slightly different. So all that I ask for in exchange is that you like this video if you get something out of it, subscribe to the channel, and let's get to it. So we're going to do things a little differently in this video. We're going to look at each of the companies in the Mag 7, and we're going to look at one of their competitors right off the bat. So here we see Apple. We have the metrics for Apple. These are all going to be growth metrics. We're not going to look at any safety metrics for any of these companies. We're going to assume that these are all growth plays. So Apple, fantastic company, iPhones, MacBooks, and the like. They're currently at a 2.88 PEG ratio, and we're going to compare them to Sony, which has a very similar PEG ratio of 2.81. Forward PE of Apple of 30, forward PE of Sony about 21. You would expect to pay a slightly higher premium for Apple than you would for something like Sony. You do see that Sony has very little debt to equity compared to Apple, but Apple has just phenomenal return on equity and return on invested capital. Their profit margins be that of Sony's. We couldn't find reliable growth information for the revenue, so we excluded that. But for EPS growth, Apple basically doubles them for the next 5 years. Free cash flow, however, free cash flow yield, Sony's got them beat. The forward PEs are pretty similar, slightly lower for Sony. So if you're new to this channel, what we do is we score companies based on these metrics. Scores from -10 to +10. -10 is absolute garbage. +10 is a fantastic company. And we can see that actually both Apple and Sony score the exact same according to our inner flame methodology. They both get a 2.8. Next, we're going to compare Microsoft and Oracle. In the interest of time, we're not going to go through every single number for every single company. We'll just keep this brief, but we can see that the numbers really tell quite a story. Return on equity for Oracle, about 70% versus 32% for Microsoft. However, the debt to equity for Oracle is considerably higher, unfortunately. It's 4.37 versus Microsoft's 0.33. We do see that the free cash flow yield for Oracle is negative. And when we take all that into consideration, we see that Oracle is scoring a 2.8 on our scale versus Microsoft's 6.1. Next up, we have Meta and we have Pinterest. Meta, of course, is Facebook, it's Instagram, Threads, WhatsApp, all that stuff. But we can see that Pinterest, just by the numbers, has Meta beat. Forward PE of 14.46 versus Meta's 21.66. Debt to equity 0.04 compared to Meta's 0.26. Profit margins at almost 50%. 5-year forward PE at just a 4. So you can see that when we take all of this into consideration, Pinterest is getting an 8.9, the highest score of all these companies today versus Meta's 6.1. Now, next up, we have Google and Netflix. We're comparing these two because Google owns YouTube, and YouTube is one of the most frequently used streaming platforms around. So when you're watching a YouTube video like this one, thanks again, you are taking time away from watching Netflix. And so we're comparing these two companies mainly for that reason. Google has a lot of competition, but a lot of that competition comes from within the Mag 7 itself. So looking at the numbers, we see they're very, very similar, and we see that in the scoring. Netflix comes in just a tick higher than Google, 6.1 for Netflix and 5.6 for Google. Next up, we have Amazon, and we have the Amazon of China, which is Alibaba. We see a lot of similarities in their numbers. We see PEG ratio, however, for Alibaba coming in over 2, which we do not like to see. Amazon at a 1.64. It would be nice to see that a little bit lower. We see their 5-year forward PE, same sort of story, low for Amazon, not as low for Alibaba. We see return on equity and invested capital coming in considerably higher for Amazon. Profit margins pretty much the same. We see that the expected 5-year annualized EPS growth for Amazon just blowing Alibaba out of the water. And we see in the scoring that Amazon's coming in at a 3.9, Alibaba coming in at a 0.6. Next up, we have AMD and NVIDIA. Both have PEG ratios under 1, which we like to see. Debt to equity slightly lower for AMD versus NVIDIA, but they're both very, very low. But when you start looking at their returns, just blows AMD out of the water. When you look at the profit margin, NVIDIA once again blows AMD out of the water. AMD is expected to grow revenue and EPS by a lot more than NVIDIA, but we start to see 5-year forward PEs for NVIDIA still beating AMD. And that comes in the numbers. We see NVIDIA coming in at a 7.8 and AMD at a 3.3. And finally, we have Tesla and GM. Tesla's in the Mag 7. GM is making electric vehicles. They make the Chevy Equinox EV, which is a more affordable SUV electric vehicle. We do see that the PEG ratio for GM is fantastic at a 0.71. PEG ratio for Tesla, I mean, way, way, way above 2. It's a 22.09. Forward PE for GM, a very low 7.15 versus Tesla's 220. And we extend that out to 5 years. Tesla, if you bought it right now, you're buying it at a 5-year forward PE of 122 versus GM's 8.75. Free cash flow yield for GM is a 19.17. That is phenomenal. And we just see that GM, not the best numbers, but we do see pretty decent numbers from GM, especially when it's compared to Tesla. GM is coming in at a neutral 0. Tesla, unfortunately, the only negative score that we see for this video, a negative 3.9. Now, as Warren Buffett said, price is what you pay, value is what you get. We want to make sure that we're getting a good value on all of these companies. And so we've run different intrinsic value calculators for each company in this video. We've done a PE ratios model, we've done a discounted cash flow model, and we've done a Peter Lynch valuation model, which is a version of the PEGI ratio. We do have a dividend discount model, but we will not do that for any of these companies because none of these companies are really known for paying out solid, consistent dividends. Now, if you want to see how to make these spreadsheets, these intrinsic value calculators yourself, so you can do these for not just the companies featured in this video, but for any company you want, you can go ahead and check out the links in the description below. And so the first company we will look at is the one with the lowest score. That would be Tesla. Remember, Tesla came in with a negative 3.9. Now, the Tesla bulls are going to get mad at this one, but the price is currently $4.49. We think it's really worth $65. That's based on their growth. That's based on what they're projected to do. That is not a good margin of safety at all. You're paying a 590% premium for Tesla right now. We want to buy it when it's about $55. That would give us a nice margin of safety of about 15%. And we want to buy heavily if Tesla gets down to 42. Now, Tesla's probably never going to get down to those numbers, but Tesla, it lost its current leadership status as the biggest EV seller in the world. China beat them out. I believe that was XPEV or BYD. I forget which company beat them out, but Tesla is no longer the #1 EV selling company in the world. That now goes to a Chinese company. So they've lost their leadership status in that regard. Now, they do have a lot of stuff in the works, robotics, energy storage, and all the like, but based on the numbers that we look at on this channel, how we value stocks, Tesla, probably not a buy anytime soon. Now, GM came in with a score of 0, but they do have a decent margin of safety of 28.5%. Whether or not we buy it with a score of 0 is a different matter. Of course, nothing that we say on this channel is a buy, hold, or sell recommendation at all. We are not financial advisors. We are not giving you financial advice. We're just showing you how we do things for entertainment and educational purposes only. But GM has a decent margin of safety, 28.5%, but they do have a low score, so possibly something to consider maybe putting on a watch list. Alibaba, slightly better score at 0.6, but a negative margin of safety. So you'd be paying a 28% premium for Alibaba's current stock price. Apple, 2.8 score, so not too fantastic, but it's getting up there. Margin of safety at about 28%. We would buy Apple if it dropped down to 173. We would buy a lot more heavily if it ever got down to 132 or lower. Oracle, coming in also at a 2.8. Margin of safety of 0.2%. So we basically think that Oracle is trading for what it's worth, 205 versus 205. Sony, which we're comparing to Apple, same score as Apple at a 2.8, but their margin of safety is a 64%. And we checked and double checked these numbers, and just based off of what Sony's expected to do in the next 5 years, we project that out based on earnings, based on free cash flow. Sony just seems like a pretty decent stock in terms of the margin of safety. Next comes AMD, scoring at a 3.3. This is the competitor for NVIDIA. They have a beautiful margin of safety of 54.5%, currently trading for 208. We intrinsically think it's 456. So we would buy AMD based on margin of safety alone at 388. We would buy very heavily under 296. It is under both those values. So this might be something to consider in our portfolios. Amazon coming in at a decent 3.9. Margin of safety based on their numbers, negative 7.2. So they're currently trading for 246. We think that they're really worth 230. So we would consider buying Amazon at 196, more heavily at 150. Now, Google's the first company coming in over a 5. However, they are trading for fair value, basically, currently trading for 332. And intrinsically, we think that they are 330. We would buy Google at 281 if we wanted a 15% buffer. We would buy it a lot more heavily if it ever got down to 215. Meta coming in at a strong 6.1. However, we would be paying a margin of safety of negative 11%, so an 11% premium for Meta. Buy it at 491, buy much more heavily at 376. Microsoft also at a 6.1, also paying a premium for Microsoft. It's currently trading for 477. We think it's worth 444. We would start to buy Microsoft if it got down to 377, and we would buy a lot more heavily if it got down to 298. Netflix coming in at a 6.1 as well. Margin of safety, also paying about a 5% premium, roughly trading for market value. The market value is roughly the intrinsic value, trading for $89 per share. We think it's worth 85. We would consider buying Netflix at $72 per share, buying it much more heavily at 55. Now, next up is NVIDIA, and its competitor, of course, is AMD. You look at NVIDIA, very solid 7.8, has a margin of safety of 43%. When you compare that to AMD, we see that AMD does not have as high of a score, but it does have a higher margin of safety. So this might be something where if you wanted to get exposure to these companies, maybe $1 into NVIDIA for every dollar into AMD, or maybe a 2-for-1 sort of ratio where $2 go into Netflix, $1 goes into AMD, or vice versa, 2 into AMD, 1 into NVIDIA. Depends on how you want to play that. NVIDIA is certainly a buy under 278 and buy heavily under 213. The current stock price is under both of those. So if we wanted to expand our position into NVIDIA in the Interflame portfolio, we would certainly be buying this a lot more heavily. And finally, top of the leaderboard, Pinterest at a solid 8.9, very close to a 10, and a wonderful margin of safety of 50.3%. So their current stock price is $27 per share. We think that they are actually worth 54 based on their projected growth. We think that Pinterest is a buy under 46 and a very strong buy under 35. Again, nothing in this video is financial advice. We are not telling you to buy, sell, or hold anything. Always do your own research and due diligence. Check out the links in the description below for your own intrinsic value calculators. Be sure to like this video if you got anything out of it. Consider subscribing to the channel. Tell your mom, tell your dad, tell your mother-in-law all about this channel. Tell your friends and family. We want to expand the Interflame Finance community and keep bringing you this wonderful content. So thank you very much for watching. We appreciate it, and we'll see you in the next video.